Welcome to the On the Tape podcast. I am Danny Moses. I am here with Dennis DeBusschere, founder, president, and chief market strategist at 22V Research, which was founded in 2021. And for those out there who don't know, 22 is his father's number, David DeBusschere, and V standing for victory.
Yep.
And I will say that the victory you can claim, we had you on in August of last year on our formal On the Tape podcast, and you were saying no recession, and that was right after kind of the yen implosion. We're going to get to that at times, so I know you stuck with that there. And so sometimes the V can be for volatility also. So why don't we start with kind of a background on 22V real quick and the stuff that you offer. You built an incredible group of people there, and you offer a great product. So I'd like to hear about that first.
Yeah, and thank you for that. Very quickly on that, what we're trying to build and the plan was to bring unusual experts to the buy side. So even though I hung around the buy side for 20 years, we didn't want people that were hanging around the buy side for 20 years or so doing that have been doing research. So we have a lot of former buy side people that we think are excellent. You're obviously a former buy sider, so I think if you've had to employ risk or be involved with somebody, you work for somebody that's actually putting risk on, it's a different skill set, and I think something that is very interesting and can be translated over to the sell side. And if not that, experts in different fields. So almost like the old Bernstein model where, as an example, they would hire somebody out of Microsoft to cover tech. We have a former U.S. Treasury's representative in Beijing as our China research head, and things like that.
I would say that people always kind of equate buy side emanating out of Tiger Global. Julian Robertson, spurned off 5 or 6 different funds. ISI is kind of where you've seen so much talent come from, and having worked with Ed Hyman over the years. And you're always famous for doing the surveys that you guys would do at these gatherings. Are you still doing the surveys?
We are. So we do surveys pretty much ahead of all economic events. So that's like your kind of Survey Monkey, if you will, equivalent. And then when we have any event, whether it be a dinner or a larger conference, we'll do surveys related to those.
So in this case, we're going to learn. I'm going to ask you about what's going on and what the latest surveys tell you. So sometimes the V in 22V can stand for volatility.
Yep. And
it was just 8 weeks ago where things were, how can the U.S. be a trusted trading partner? Tariffs are a tax on the consumer. We were almost a certainty of a recession, dollar debasement, yields rising, credit spreads widening. And we've calmed down, obviously, but it doesn't feel like we're out of the woods. So give me your current assessment here on this kind of, and I'll use V again, this V-shaped rebound that we've now had in this market.
So I'm going to start with a survey because that's going to set up the short term. Before I get going, I want to say that we're kind of defining the world in 3 different buckets right now. You have 3 to 6 months, which is where most of this tariff uncertainty and whether or not we'll go into a recession as related will show up. You have the medium term, which is 8 to 12 months, which has a little different of an economic dynamic. And then you have the longer term, which the deficit is important for. And you kind of touched on all of that when you think about the volatility over the last 8 weeks. So on the very near term, investors are defensive and positioned as such, meaning they own growth momentum, they own quality factors, those have done well. They certainly haven't owned value, small caps, or anything that's economically sensitive because they've been waiting for the slowing in economic growth. And at the end of the day, economic growth has held up much better than expected. I wouldn't call it good. I would call it much better than expected. So in the current environment, we're in the process over the last 2 weeks of seeing what would be historically called an everything rally. Small caps, debt risk, your junk is doing the best. And that's probably going to continue for a little while, assuming there's no new shocks on the trade side. So over the next 3 to 6 months, when I think about investor positioning, be careful being negative on economically sensitive things because the economy is holding up much better than most people expected. We're not surprised it's holding up, but we are surprised that people are still so negative relative to on-the-ground data.
So it feels like the Fed put is alive and well. I mean, Powell has 8 meetings left maximum, right? Because he's going to be gone by May of next year, if not sooner. And so careful what you wish for. In terms of last week, people are like, oh, I hope it's a bad jobs number so it can push the Fed. But the point you just made, if the economy is slowing, it's going to have a hit to earnings. The market will look very expensive. So how do you weigh the 2 things of economy slowing, forcing the Fed's hand maybe in cutting short-term rates?
Sure. So I would over the medium term, over the next, say, 8 to 12 months, I would say that the Fed is actually going to welcome a slowdown in the economy. So when I think about a put, I think it's very near term. If something goes terribly wrong with trade, yes, the Fed would be forced to step in. That we know. Assuming we avoid a recession, though, I think investors really need to internalize that the Fed is going to welcome a slowdown to keep inflation and inflation expectations in check. We are going to see inflation as it related to tariffs, right? So most economic estimates or economists have core inflation moving up 1 to 1.5% above the current base rate. That'll get you to 3.5 on core, well above the Fed's target. The Fed is then going to, as a result, either cut extremely slowly or not at all this year as we go through that inflation impulse. They're going to do that, and to make sure that inflation and inflation expectations stay in check, they're going to welcome what would be called below trend growth or economic growth below 2%. Probably closer to 1.5 if tariffs stay at a relatively low level. Could be lower than that though. So investors should expect a slowing of the economy that the Fed is going to welcome, so relatively restrictive rates over the next 8 to 12 months. Then as you get into next year, you can start talking about the inflation numbers getting very dovish very rapidly, and then the Fed cutting, and that being a whole different dynamic for the market.
So let's talk about both the stock market and the economy are being driven by a few stocks in the stock market and a few people in the economy. We've seen instances where the wealth effect completely unwinds, feeds on itself in a negative feedback loop. We've had these sell-offs where it's like, okay, now the spending's going to slow. There goes services because consumer discretionary. So it's easy to say, and you're doing the right thing looking out 8 to 12 months. But this market is so instant gratification. So how do you tell people? Because you have a fire and ice regime, and I believe that you're fired. You think we're in a fire regime now where rates lower, market higher. We're still in that time period. Talk about that and how that incorporates into your mindset here.
So it's a good point. So given where we are in inflation, which is above the Fed's target, and given that the deficit is expected to continue to expand, which, whether I agree or not, it's not an issue. That's what's probably going to happen. You should expect the correlation that people are used to break down between rates and the stock market. So like you said, the correlations are flipped where lower rates is good for stocks and higher rates are bad for stocks. It was the opposite in the post-GFC period, right, when we were dealing with the zero lower bound. Okay, so what is the practical implication of that? Anytime growth is too strong, rates are going to be restrictive because term premium or the inflation risk embedded in 10-year yields is going to go up because we have a very high deficit, which is growth supporting, which is inflation supporting. And so anytime you have the private sector contributing to growth, when you already have a deficit that's expected to keep on expanding, you should expect higher rates than would otherwise be the case. It's a long-winded way of saying 10-year yields will remain at a level that keep certain parts of the economy from growing.
Well, right? But it's having an impact on the lower-end consumer, right? You're seeing it. Well,
it has to.
Right. So at what point does it matter to the overall economy is what I'm saying. Because
at some point in the future, we'll have a shock that leads to a recession. But I would argue my counter to that is you have an impact on the lower end consumer. You have an impact on housing. You have an impact on the durable goods side of the economy. They need to be weak. Sad to say, but they need to be weak because the consumer service and AI spending side is so strong that if you actually had those areas of the economy contributing, inflation would be way too high. Right? So this is something I think we're a differentiated point on, is that 10-year yields need to be somewhat restrictive, especially for the areas that you mentioned. I'm not saying it's good for society. I'm just telling you the way to think about it, which means if you're in this deficit increasing inflation, more inflationary impulse backdrop, 10-year yields will remain relatively restrictive for certain areas of the economy. Bottom line, what changes that? Right? How do you make the lower end consumer feel better? How do you make housing market improve? Consumer service spending has to slow, or AI spending slows. If those areas slow down, then the interest rates can come down, and interest rate sensitive sectors can contribute to economic growth without it being overly inflationary. Does that make sense?
It does, but if AI spending slows, the market's going to correct.
Oh yeah,
you're talking about the best part of the market, the capex cycle.
Oh yeah, which is you're exactly right. So right now, the economic backdrop. This gets back to your economy versus market point. The economic backdrop over this year favors tech and things that are not interest rate sensitive, assuming that spending continues. Now, I don't have a macro reason for that spending to continue or not. Now, you're getting into a little bit like, for what I do, you know what I do, so it's economics portfolio strategy. I am not the expert on how much Microsoft's going to spend over the next 3 years. I'll never have an edge on that. People seem to believe that they'll never stop. Never stop. I think it's reasonable to challenge that assumption. I just think it's probably when you get to like the market correction led by those stocks, it's probably going to be driven by a bottom-up analysis of people figuring out that the return on those investments are not panning out or they don't need them anymore versus some large macro reason.
It's interesting how the large cap growth / quality has turned into value. Alphabet's, almost a value stock in my opinion. Microsoft's, I wouldn't call it value, but it's cheap. And these are strong balance sheets. So these things can survive some type of rotation, obviously, occurring.
Yeah.
So it's going to be really interesting. So within the market, right? So I've been looking at various sectors that have been massively underweighted and massively overweighted. Obviously, tech is overweighted.
Yep.
Energy is completely underweighted. I mean, it's 3% of the S&P. And as a portfolio manager, your clients that you talk to, they don't really have to pay attention to it. They can own a couple names and stay, kind of market weights, 3%. But when money does come out and rotate potentially, is it the market's going to probably sell off first and then come back into the market in much more defensive type names? Is energy a sector which you like? It must be screening fairly well, I would think.
It's screening very cheap, yes. The issue with energy is where I started. The Fed wants below trend growth. China doesn't seem like it's going to have overly stimulative policy. So from a demand point of view, you're looking at a below trend growth backdrop in the U.S. that typically wouldn't be a headwind for any deep cyclical. So energy, industrials, materials would fall into like the deeper cyclical bucket. Industrials are a little bit different because they have that AI exposure. Some materials are a little different because they have AI exposure. Energy is something that I want to buy with both hands with like the force of 1,000 suns. I just can't get myself there right now because we have to get through the Fed getting inflation down to target. Now, once inflation gets down to target, it's called 2% or below, and the Fed can lower rates and let the economy accelerate, energy will be extremely interesting. It's probably going to be 6 months from now, though.
Don't you think, though, it was a secular shift in energy, between kind of the, environmental stuff where they were getting no capital at all during that time period. So their balance sheets had never been better. The M&A that's happened over the last, they're much more financially flexible.
Oh, they're great.
Than they were. And I'm not trying to sell you on it. I'm just saying in general, it feels like people are not understanding that they can just stop producing. And the other thing I'll tell you is that the shale, there's like Permian Basin, there's not a lot left to drill right now. So their ability to kind of protect
So the call that overrides, so to your point, and I should have mentioned this, I'm giving you the energy outlook from a demand point of view. So it's very difficult to get to a much higher oil price given the demand forecast that I mentioned. What I'm not taking into consideration is, yes, the rig count has come down. Right. So there is a supply story potentially that makes that you don't necessarily need the Fed to be cutting for energy to work if that supply becomes very binding, meaning obviously encouraging higher oil prices within it. But we're not supply experts. I would just say I don't want to fight the Fed in the sense that if they want below trend growth, we should probably own things that will do okay in below trend growth and not own things that do pretty poorly in below trend growth. And that gets back to just like, don't fight the freaking Fed.
So what are your earnings estimates right now in 2025 for the S&P? 260?
Yeah, it's about 262, yeah.
And the stuff you're talking about sounds like that might be too high. If you're talking about potentially what you see, how you see this playing out, rates stay a little bit higher, stubbornly higher for a little longer. There's some tariff impact going to be occurring. Is it the back half that you see growth reaccelerating again in earnings, or because it sounds like you think there's the correlation between GDP and earnings growth is very poor over time. But stepping away for a second, when you look at what I'm talking about in the economy, which is below trend GDP growth, but you're also looking at a weaker dollar over the course of this year, S&P earnings will be just fine because they do benefit from that weaker dollar. So just keep that in mind. S&P earnings are a lot more insulated from GDP growth than small and mid-cap stocks. That's where I was going next. So let's talk about small cap.
So
let's talk about small cap. I mean, that's not an area it seems like you would want to own in the scenario that you're
you have so it gets back to time frames, like very near term you have this case for re-rating in small caps over the next month or so, just as we don't enter a recession. Small caps like housing, like deeper cyclicals, like the value factor all fall into this bucket of on the wrong side of what the Fed wants to accomplish as long as inflation is above target. And let's be clear about this. The tariffs are going to lead to inflation that's going to be well above target. And even though the Fed, everybody screams about the Fed being political, I don't really give a damn. I just focus on what they say. And what they said is they will make sure that inflation and inflation expectations stay in check, which means they're going to encourage slower GDP growth. So as long as we believe that they're going to do what they're saying they're going to do, small caps will face a headwind. Now, when you want to own small caps, and hopefully this is helpful to investors, is when we all get comfort as an investment community that the Fed is more pro-growth. They want economic growth to accelerate. And when that happens, given where the small cap multiple is relative to large caps, which is basically at the post-COVID lows right now, same actually relative to mid caps, they are going to re-rate higher aggressively.
So how do you incorporate kind of the Fed's balance sheet? Because that is an area that Scott Bessent obviously could have an impact on in terms of trying to help keep 10-year yields low to basically fund the government, which, right? So we're now running off 35 or 40 billion a month, 35 billion in mortgage-backed securities,
Sure.
and only 5 billion in treasuries, which is like a token amount. We could get an update next week kind of on that. And the thought is that anything, or not the thought, that they've said is anything above 35 billion runoff in mortgage-backed securities are going to reinvest into treasuries. We've already seen the government buying treasuries out there in some of these auctions. So how do you think about kind of the artificial price of the 10-year yields and what the natural level is?
I think about it a lot less now because the term premium is positive, right? So what we are seeing is the market look through that to a certain extent, and you're seeing term premiums. So for people that are listening, that's the kind of inflation or unknown risk embedded in 10-year bonds. So on across the curve, term premiums have gone from deeply negative, which one would argue when you had negative term premiums that you had manipulation by balance sheet forces, to decently positive. I mean, 50-something basis points if you believe the New York Fed model on Bloomberg. So given that we have higher term premium, it seems like deficit concerns and inflationary impulses over time are swamping what the Fed and or Treasury might do with manipulation of yields.
And will it ever matter? I mean, we raise the debt ceiling $4 to $5 trillion here and just extend it for a year and a half. When does it matter? The debt in terms of debt levels.
See, this is a question I wrestle with a lot because we should step back, and this is like a whole nother podcast because this gets back to the fire regime we've talked about.
Let's go back to right now.
There was a good 20-year period where people cried wolf on the deficit, and they shouldn't have, right? And now, actually, we should be crying wolf.
What was it when it went over 1-to-1 in terms of
and in the post-GFC period, you had a large acceleration. Good point. We had a large acceleration in the deficit, and then continued in the first Trump administration. But it wasn't as concerning because your equilibrium interest rates were below estimates of potential GDP, right? So the estimate, like the market estimate of what the neutral Fed funds rate over a 10-year period was below your estimate of GDP, which in theory means you can run very high deficits, okay? But that's changed. Right now, technically, and I'm giving you a false sense of precision, but technically estimates of R-star, equilibrium interest rates, are above estimates of potential GDP growth. So if you're growing your primary deficit at 3.5% a year, which is the estimates right now, and the primary deficit is just your revenues the government takes in versus spending, estimated to be 3.5% a year, and your interest rate is equal to nominal GDP, then you're going to grow the deficit by 3.5% a year. And if that interest rate goes up, right, then that's where you get these hockey stick charts. So it's absolutely relevant, and there could be a forced fiscal consolidation. My issue with this is that it's very hard to time. So what does that mean? I think you should all just assume that Treasury volatility is going to be higher, that bonds will not be diversifying. This is a really important point for investors. It gets to the fire regime. So if you have higher bond volatility, which is basically double where it was in the post-GFC period, and then bonds are not diversifying, right? They're potentially exacerbating, right? So think about the Bridgewater model, the old 60-40 model, which is essentially long stocks, long bonds, and stock market goes down, you offset it with a bond market increase, right? Bond price increase, excuse me. But that's not the case right now. Bonds are not diversifying in this world if you're in a fire regime, and we existed in this world in the 70s. Side note, that's when gold did really well.
Yep.
So if your risk-free asset is not diversifying, things like Bitcoin could look really attractive.
Well, gold and Bitcoin are telling us something, right now. So
precisely. It's telling us that you should probably be hedged against an event. The problem is I'm not so sure when that event would come, but I think it's really appropriate to hedge against it, which is where you get to the Bitcoin and gold point that you just made. And obviously, the market seems to be sniffing that out. But I mean, the projections are like our projections would get you to like 140, 150% of GDP debt from a current 103 at the end of this year or something like that. Very high. Japan made it to 260. Like,
yeah, made it.
Yeah, no. Just say like, I don't want to say that there's going to be an event, but I do have strong conviction, or as a firm, we have strong conviction that it matters for bond vol, it matters for term premium, it matters for how you think about portfolio allocation today.
So some people use debt of 27 trillion, and some are 28 to 29, and some use the total amount, which the Fed is obviously sitting on some of that. So I don't know how that incorporates, but you do see numbers where we're 125% debt to GDP because they're counting the entire amount. Yeah. Why are you excluding what's on the government balance sheet in terms of the paper that we own?
Mostly because that's where most economists quoted at.
I'm just curious. Well,
so I don't have any reason to exclude it.
But it had never been that high. I'm saying before 2008, it didn't exist.
Yeah, I wouldn't push back against that as a reason.
Okay.
I would just say that I'll give you a really cheap answer. I would assume that the market participants in aggregate are taking that into account.
Okay. So let's
It's not like they haven't figured out that that's there.
No, I understand. I hear that all the time, and I'm like, I get two different numbers, and so if you look at Japan,
Fair.
I think Japan has a ton of it too, but they include it in that.
Sure.
Number.
I would just say it's an important point, and I don't really have a good answer for it, I would say, but it doesn't change a bit of a distinction without a difference in the sense that it still means higher term premium over time. It still means steeper yield curves over time.
Well, fair. And I want to go back and dumb down the R squared thing. And basically what you were saying, and I think what people should understand, and the now a brand new generation of investors that haven't traded, that were never traded before 2008. Fiscal stimulus. Everybody knows monetary stimulus, but fiscal stimulus had come in the various forms of spending by the government, various programs doing it.
Tax cuts, spending, whatever.
Right. So the fiscal part of it. So basically what you're saying is that's not sustainable. So how much has or at least the amount that it was. So how do you think about that contributing to kind of growth within the economy and that feedback loop to a degree? And how much impact does that have?
It has a lot of impact on inflation.
Okay, but not just inflation, on spending.
Oh yeah, no. So the you don't care in a sense if it's growth positive, it doesn't lead to inflation. In a sense, like it comes back to the R versus G. Like let me just I'm going to give you an academic example. I'll dumb it down as much as I can. That is not reality, but let's just give you the theory for you know what and giggles. So you have a lot of fiscal spending, and let's just say it's highly productive.
Right. Okay.
The awesomest fiscal spending. Okay.
I think a lot of it might have been.
Yeah. No. But just say it's as for argument's sake, it's highly productive. That's a tough argument to sell, but
sure.
Thank you. Yeah.
Yeah. I got you. We'll go with that.
Yeah, we'll go with that. So it's non-inflationary in a sense, and you end up where your interest rate on that debt stock is, let's say, below potential GDP because you have very low inflationary growth.
It's a good situation.
Very good situation. What it means is that the deficit, if it's well below, like if your interest rate is well below your growth rate, the deficit is theoretically self-liquidating over time. It's not an issue.
Fair enough.
Okay, that's so when you think about the post-GFC period, we had a lot of fiscal spending coming obviously out of the crisis. We had some fiscal belt tightening, mostly by state and local governments, by the way, roughly to 2016, and then we had the Trump stimulus where we had some more acceleration in the debt. All that while, that was welcomed by the market from a demand point of view because rates were zero and growth was positive, right? So that debt is self-liquidating over time in theory. All right, so fast forward to today, the main difference is that we have a continued deficit increase, which supports demand, which means that there is more and supporting demand in a relatively where the supply side, to get technical, meaning labor and productivity, is not high enough to support that. Right. So if you're running a growth of 2.5% to 3%, which the deficit would encourage, stronger growth, and then you have a private sector that's because the other side of the deficit, by the way, fiscal deficit is a private sector surplus. So the private sector is in a very healthy position. Mm-hmm. So you put those two factors together, you're probably going to have above trend GDP growth unless it's offset by higher interest rates. And then when you offset that with higher interest rates and inflation's related to all this, you can project very high deficits over time. So my point is, if you have inflation, which is highly, highly likely in the scenario where we have any private sector growth, right, with an increasing deficit, then you're going to see equilibrium interest rates increase consistently to offset that inflation.
You sound nervously bullish. So you have a bullish hat on, but you are pointing out all the things that are probably...
Well, when I'd say it does mean lower GDP growth, probably lower market returns over time, but it's not bearish.
No, I understand. You're caveating. So this is important. Let's go to the surveys.
But why? Okay, we'll go to the surveys. But I was going to say, but just remember, one of the reasons you're going to be always bullish on the U.S. On the stock market now is because we have these monsters that have extremely high return on invested capital relative to the cost of capital, and they're very nominal GDP sensitive. So as long as it's the reason it's very difficult to be, as long as you have positive GDP growth in the U.S., it's so hard to be negative on the S&P because the top 100 companies, not just the top 10, the top 100, are such efficient users and returners of capital that it's like...
That's fair. And the irony in all this is it's a great stock picker's market if you look past those kind of top 10,
Oh, yeah.
a lot of companies that are being either left for dead that are doing well, and you can buy them,
Sure.
or are over earning, potentially, have debt on their balance sheet. It's not going to get refinanced. So
Sure.
there are opportunities. They're just not as widely followed, and they're unheard
Absolutely.
of. So that's what I try to focus on. I know you try to do as well.
Sure.
So your surveys, I've been to many of these dinners and so forth, and normally the surveys are happening during the course of the dinner. There's some wine being poured.
Sure.
It's a lot of truth serum that goes out there, and it's always great to get that feedback. So give me an idea. And you used to do things like, where will unemployment rate be? Where will the S&P be? I don't know how specific you get on inflation reads per se, but give me an idea of what you've been getting back from your clients here.
Let's say the main things we're getting back is a market that's probably more a headline market that's more biased to be lower than higher from here. Labor market that's going to slow aggressively over the next 6 to 8 months. So
Unemployment rate, is that how you're measuring it, or are you?
Oh, sorry, a headline payroll growth of like 50 to 60,000.
Okay. Unemployment
Unemployment rate people think is going higher, not materially higher, but they think it's going higher. And most people think that the Fed is going to cut more than is there certainly indicated.
What about 10-year yield? You have to be asking.
Universal that it's going higher.
So the universal people
Yeah.
believe, which tells me the market's probably going higher from here, is that slowdown in the economy, long-term bonds yields go up,
Yes.
right? So what kind of glimpses of what we saw? What about the dollar? Have you asked about that as well?
Universal down. And we have asked about that. That's
So
like
what
the
we saw,
easiest,
basically.
Yeah, that's like the easiest one. Meaning, it's, when I say the easiest one, that's like out of all the things I just mentioned, that's the most consensus.
It's interesting when you get time periods like when you were on in August, and kind of the yen was going crazy, and it had an impact on our markets. People couldn't figure that out. When the tariff news came out, in early April, you got a glimpse of what can go wrong, right? I'm not saying it was all a result of that announcement, but it's like, all right, dollar debasement, gold moves higher,
Sure.
rates go higher, and I feel like that's going to be with us. I feel like that scar tissue is going to be with us, and that's what your surveys are basically saying. These people are still impacted.
Oh, yeah.
Of the stuff. You can't unsee it, right?
You can't
And so-
unsee it, and the forces coming back to the deficit, let's just say, or just trade policy in general, seems like will encourage. I shouldn't say encourage, but it wouldn't be shocking to see events like that every year for the next 3 to 5 years.
Yeah.
Like, why would we expect otherwise? We should expect, if we leave something with people, leave it this, significantly higher volatility in rates and currencies than what we are used to. Right?
Period.
Meaning the post-GFC
Yeah.
period through that's it. Like, there is rate volatility is here to stay. Best trade then, by the way. Can I throw this out there?
Please, that's why we're here.
Oh, yeah, no. So thinking about relative to the surveys,
Yeah.
and this even goes against some of our calls, but I should be mercenary about this. If 10-year yields go down and bond volatility comes down over the next 2 months, when everybody's expecting it to go up,
Yep.
you could see small caps go up like another 10%, just the pure pain
100%.
trade. It's like
It's a factor. It's a massive factor.
It's a massive factor. Like the debt risk names that you say, like the ones that probably can't refinance at a attractive rate and are over earning, like those names just go way up. And I have the same exact call as you. I think those are great relative shorts over the next 8 to 12 months. But the next month and a half, if that 10-year yield comes in, we get a better CPI tomorrow. There's some seasonality. We're unsure when tariffs are going to impact. Like, I could see that happening.
This is not a conspiracy thing at all. But the truth is that BLS is understaffed now. And they're
Yes.
now estimating almost 30% of the numbers. So it adds a lot to finagle things there. So before, I think it was 15. But put that to the side for a second.
And it's not a conspiracy theory. It's a fact.
It's a fact. Right.
Yes.
But I'm saying the conspiracy is that, let's use that other 15% we can't get to point us in the favor of let's make the Fed go. Let's make the Fed move. I'm not saying that's the case. But I want to take that to the side for a second. The jobs number that we just saw, okay? The fact that you're going to make a decision, not you, invest on a 35,000 or 39,000 better than expected number when the previous 2 months were revised lower. And by the way, this goes back to forever in terms of being able to household surveys and all that stuff that goes on. That's, to me, is a dangerous premise because it could go easily. Like, you can't trade the market longer term on a 39,000 job beat that was revised lower anyway the previous 2 months. Like, that's just not a healthy way to trade the market.
It's not, but it goes back to where we started on surveys. People were set up for negative data
From the ADP number 2 days before. But I'm saying that's
the city surprise indices rolling over, which
Yeah.
I think are, I'll be kind on that. Let's just say I wouldn't rely on them. I mean, meaning they're obviously what they are, but they're not necessarily tell you anything about levels of economic growth. But anyway, that's what happened.
Do you think the market's prepared for not just the tariff impact on prices and inflation, but on slowdown? If you're a small business and you add up a lot of the small businesses, it's a lot of people.
Yeah.
You were trying to plan 2026 already. You already have your 2025 plan.
Yeah.
You're now not ordering as much stuff. You're just that little bit of uncertainty. So we talk about inflation on one side, but there's also a demand of goods on the other side of that. I don't think the market is pricing that part of it in. I think they think, oh, inflation, it'll be transitory because they'll readjust to this, whatever the new is going to be. But I don't think these companies are going to be so quick just to trust the system enough to just turn that back on. And I say that because we already were having layoffs in large public corporations in tech for the last 6 to 9 months of, and then we've had, I think, the smaller stuff we've seen out of the smaller business surveys and stuff like that. So it just seems like that people are painting potentially the best case scenario for that. They're looking at one side but not the other.
Yeah, so my counter to that is if you're looking at the S&P, you can make that argument. If you're looking at small and mid-cap stocks, they've been relative losers, which would be impacted the most by the things that you would say. That you're pointing out, excuse me. That's one. Two, a slowdown is absolutely going to happen. Like, this is not something that I think people should be blind to at all. In economic circles and macro circles, it's very well discussed, less so in the equity markets. I would say institutional hedge fund investors are very aware of it. I think if I were to say where's Waldo here, for whatever reason, retail seems to have been a large reason why you might be seeing optimism on the outlook and not necessarily reflecting some of the things that you're mentioning.
So let's talk about kind of the banks and then private credit and private equity, I should say, and the role now that we've seen kind of a switch, right? We've seen kind of, private equity. How do you look at that? How do you track it? And it's obviously had a positive impact on credit spreads near term, but that could quickly turn if credit starts to deteriorate. So how do you think about just the amount of money chasing these loans that are out there?
I think it's a 10-year melting ice cube. I mean, that's the fact of the matter is we all know that marks are too high. We all know that they overpaid on the private side for years in an effort to displace the banks and be more aggressive on the lending side, as you know. I think we shouldn't get over our skis on an event unless, the Fed has to raise rates like much more than expected, like there's be a financial condition shock. Then you would have a negative feedback loop develop. And the reason why I think it's a 10-year melting ice cube or 5-year, just thinking longer duration terms, is because it comes back to something I said earlier that keeps getting forgotten. Private sector's in surplus. Households, corporations are in surplus. The household and private sector financial balance is nicely positive to the tune of almost 6% of GDP. It was negative going into the GFC. It was negative going into 2000. If we were in that type of backdrop now, then I'd be much, much more worried about private credit and a more aggressive unwind. But it's just more of a melting ice cube from here.
So I want to go a little bit more into private credit here and the role that they've been playing as opposed to the banks. And the banks have been busy doing their stuff that they've been doing. The Wall Street banks, I should say, traditionally, a lot more IPOs are happening, M&A. They're expensive, but they're fine. They're not going to be the crisis point if something does go wrong this time, right? So it's going to be hard to find it because it's so spread out within private credit. But the impact of private credit, I'm going to go back to the credit spread question again because they've come in a ton. But it all points back to 10-year yields. It all points back to that. So Scott Bessent knows it's the most important thing. And we'll talk about, we've talked about already a lot about it, but the reasons that it might go higher are very important.
So when you think about the impact of credit now on private credit, and let's call it the economic cycle, because that's what we ultimately care about is what would, unmoor the economic cycle. It's going to come down to the reason why 10-year yields are increasing. And if the reason why 10-year yields are increasing is more related to a more positive real GDP growth outlook, so in simple terms, think about inflation around the Fed's target of 2%, call it 2% economic growth, 4% nominal GDP-ish, so a little bit of term premium, so 4.5% 10-year yield, not a problem. If you have much higher, though, inflation potential and the deficit is concerning to people, and you have a 5% 10-year yield or higher or something like that relative to 4% nominal or 2% real GDP growth, and that's an issue potentially for a more acute issue is probably a better way to say it for the private credit area. And then you could see a more quicker unwind than I would be forecasting.
All right. I want to get one last thing back to the Fed here in terms of they're coming next week. You're not going to get a movement, obviously. We're going to get a summary of economic projections. We get that kind of quarterly. We know that Trump's going to continue to make noise. He's seeing other central banks lower rates kind of around the world. He wants to lower 100 basis points right now. Kevin Warsh is obviously in his ear. He's got. Do you think that? I mean, I think there is going to be some type of crisis on our hands with this, with Powell going. And the reason I say that is not because the Fed will turn more dovish if Powell's not there, but I don't think he's going to make it through to May of next year. That's my personal feeling. On Kalshi right now, it's 12%. So you're getting 8-1 basically, and it was 6. It was basically 20-1. What if that were to occur? I'm just curious, and I'm sure you didn't ask in your surveys this question at all. But what message does it send, and what will the market reaction be?
I mean, the market reaction would be obviously bearish. I mean, it would I would say to the tune of something more than 10% down. So if Powell doesn't make it, and let's just say that he is, because you can't technically be forced, but maybe he's
really?
Forced some, but you know what I mean?
Right.
Like you're forced some way out, like,
right.
without getting into the kind of the documents.
Sure.
Let's just say he's somehow
right.
forced out.
You mean the law?
Yeah,
Okay.
yeah, exactly.
Yeah.
Then I think you're looking at a 10% or more event, and yeah, I mean it, and then it could be a lot more than that, depending on who the replacement would be, right? If it's Waller, it might be okay-ish because he's already there. He's dovish, but he's someone that's been on the Federal Reserve Board and showed some economic or intellectual kind of.
I just don't think anyone thinks this is happening.
No, they don't. No one thinks it's happening.
I'm not saying it. I think the odds are about right.
I think people believe that Scott Bessent has gotten to Trump in some way, shape, or form and said, like, you can't force this. That's what people believe. So
Right.
to your point, and that Trump started to understand that when the dollar was unwinding and the Treasury yields were going up when he was making those same comments at the wrong time.
Well, so let's talk about the tax bill, because that's the last thing I want to hit on here, because that kind of coincides, because I think Trump or the White House or certain people in the White House believe that if the Fed is more accommodative, it makes longer-term yields come down. I actually think, and I think you agree right now, that would be the opposite.
Yeah,
but trying to get this tax bill through, I think, is also in the back of his mind in terms of, if I have an accommodative Fed, I can push this through because it'll just seem better overall. Like he needs him to.
Yeah, which as you and I know, that's insanity. Like
right, no,
I think so. But he might believe that. Yes, we should probably both assume that Scott Bessent knows that that's not true.
I know Scott Bessent knows this, but he also knew how dumb the tariffs were, and it took a couple weeks to get to him.
Totally fair. So. I guess your premise is that like he'll do something more aggressive now potentially to make sure that that they can get the tax bill done, and Congress probably doesn't know better either.
Correct.
Right. So maybe there's a few of them that do. I'd say that's a major tail risk. But if you want to talk about aggressive upside risk to rates, which then gets back to private credit and all these things potentially unwinding, it would be some situation of pushing through the deficit and installing meaning the budget bill that's at deficit increasing and installing some very dovish Fed governor. That would be now it ultimately wouldn't happen.
Yep.
Because I think the hint of that, markets start imploding.
I agree. So it'll stop. What happened? I'm just saying there's a put and a call. Obviously, in the Fed, there's a Fed put and a Fed call.
And which bomb vigilantes are back.
Yep.
Thank God.
Yep.
Right. I mean, because that's actually worked. We're seeing the same on the dollar. I mean, the dollar is going down for very basic macro reasons longer term. But yeah, I mean, the aggressiveness of dollar sell-offs and Treasury bond sell-offs should be a constraining factor.
Last thing, I know you have an analyst that covers this in the metal space, but your view on gold?
Kind of goes back to what I was saying earlier. If treasuries are not diversifying as much as they were, then you should probably be a little bit, and you just have higher rate and dollar volatility longer term. Gold, silver, I guess Bitcoin can be thrown into the mix there to the extent that people look at it as a gold or precious metal surrogate. So positive.
Yeah, on an inflation-adjusted basis, gold is flat since 1980, by the way. I don't think people kind of realize that. And again, old school versus new school of investors that are out there that haven't seen cycles like this, that also only knows that the Fed has your back, the government's going to bail you out. It's just,
and I get the logic, by the way. Like when you had a 20-year, 30-year cycle of inflation going down, right, there was not a real, and bonds being diversifying, going back to that kind of ICE regime, gold made less sense. It makes a lot more sense in the environment that we're talking about now.
Do you think the market's ignoring geopolitics right now in general, the stuff going on around the world? I can't remember a time period in our lifetimes where things were this volatile. And I guess
Yeah,
I guess
yes.
there's so many things going on, you can't worry about them all.
Well, that's what I was going to get at.
Yeah.
Like, and I,
The wall of worry, right?
yeah, and it's one of those dumb jokes that somebody used one time when under the last administration when he was calling him Rocket Man was firing a few rockets,
Yeah.
and everyone was like, "Why is the market
Korea.
reacting?" Because, and this is probably relevant today. Is like, well, if there's going to be a nuclear war, you're really going to sell a few Apple shares ahead of it.
Fair.
Like, yeah, to your point, like there's
Yeah.
so much going on. It's like, how do you actually? I guess you own some form of tail risk, and then you just go about your job, because trying to like factor in geopolitical right now, I think, is
Yep.
very difficult.
So how do people find 22V? I know you cater to mostly institutional, but you do have a retail.
Yes, we do.
channel as
Yeah.
well.
So 22vresearch.com. We do have some offerings for retail investors. You can see it there on the website.
So you have events. I've been lucky enough to attend some of your
We have
events. I'm
events
sure
all
you'll
the
have
time, yeah.
one this summer.
We always
look
do.
forward to seeing you there. And I got to tell you, that jacket thing you have on is amazing. You look great. Great summer jacket. People that can't see it on TV, that is. I kind of want to bet on something that I can win that jacket. Can we make an S&P bet for the year, kind of year end thing?
Oh yeah, yeah.
All right, I'll give you a huge cushion. I will go under 5,700 at the end of the year. And
All
you
right,
can take
done.
over.
I'll
and you
take
can
over.
can have this.
Okay.
And,
That's
and
a
I'll give you
master's
that.
jacket.
Yeah,
That's
I'll
pretty
give you
good
that.
one. Yeah, done. I love
okay,
it.
done.
Yeah.
All right. Well, Dennis, thanks so much for coming on. Hope to have you on again before the
All
year's
right.
over.
Awesome.